Semiconductor company Applied Materials reported quarterly financial results on August 15, 2024, which I will share with you the details of in this video. I'll also update my buy recommendation for Applied Materials stock. I've had this semiconductor stock rated as a buy all year long in 2024. You're going to want to tune in to see if I'm changing that recommendation following these financial results coming out of Applied Materials. There's a lot to cover, so let's get into the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So Applied Materials reported revenue of $6.8 billion, which was up 5% from the same quarter the prior year. The company's operating profit margin increased to 28.7% from 28% during the same quarter the prior year. Non-GAAP earnings per share of $2.12 was up 12% year over year, and the company generated $2.4 billion in cash flow from operations. If you divide the cash flow from operations to revenue, you'll notice the company generated roughly 33% in cash flow from operations to sales, which is a solid metric to be sure. Applied Materials CEO saying the race for AI leadership is fueling demand for our unique and connected portfolio of products and services, positioning Applied Materials to outperform our markets over the longer term. Applied Materials will benefit from the rising effectiveness of artificial intelligence and more artificial intelligence moving to the edge, where electronic devices will need greater memory and greater storage. That's right in Applied Materials' wheelhouse. Still, investors were not thrilled with the results from Applied Materials. As you can see, the company's earnings release right here, marked with the E, the stock price dipping following the earnings announcement down to $201 per share. Still, year-to-date in 2024, Applied Materials stock is up nicely from $160 per share to start, up to $201 per share. Of course, I'm happy about that because I recommended Applied Materials stock as a buy, and I last updated that recommendation on May 16th. I'm going to update this again at the end of this video. Looking ahead, in the fourth quarter of fiscal 2024, Applied Materials expects net revenue to be approximately $6.9 billion, up from the previous quarter, and non-GAAP EPS is expected to be in the range of $2 to $2.36 and $2.18 at the midpoint, which would also be an increase from the previous quarter. Now, we've heard from several semiconductor companies highlighting that the semiconductor industry is recovering in the back half of 2024, but only slightly. The greater share of the recovery will likely happen in 2025 and 2026, as the industry absorbs any excess inventory that was left over from 2023 and then really starts to fulfill the increasing demand starting in the back half of 2024. Looking at the categories for growth for Applied Materials, you'll notice that DRAM and flash memory grew nicely in its latest quarter. DRAM now consists of 24% of the company's overall revenue, and semiconductor systems overall increased to $4.9 billion in revenue, up from $4.7 billion in revenue. DRAM and flash memory specifically, I've heard good things from industry participants about the recovery in demand for this market. Micron Technology, one of the giants in that industry, suggested demand growth will be in excess of double digits for each of these two markets over the next 5 years. And to make matters even better, Micron Technology expects supply of these not to increase by all that much. So demand will increase much more than supply will increase, giving favorable economics for companies like Applied Materials on pricing and pricing pressure. Now, whenever I see a company increasing its earnings per share, it's important to consider how much total assets changed to drive those increases in earnings per share. The reason that's the case is it's not that impressive if a company doubles its production facilities and earnings per share only increases by 10%, right? Imagine one restaurant that generates $100 in profits in 1 year. In the second year, it adds a second restaurant and only increases profits by $20. That's not as impressive, right? Now they're generating an average of 60 per location in profits, whereas previously they were generating 100 per year in profits. So profits increasing is excellent, but profits increasing as a result of increasing investments, increasing size of the business is not as impressive as it would otherwise be. So let's take a look at its balance sheet. From October 29th, 2023 till July 28th, 2024, the company's total assets did increase to 33.6 billion, up from 30.7 billion. So a roughly 10% increase in total assets. However, the vast majority of that increase in total assets came in terms of non-employed capital that's not employed in the operations of the business. Things like cash and cash equivalents increased by 2.1 billion to 8.3 billion, up from 6.1 billion. So this isn't money that the company put out into the business. This is just cash that the company generated, and so it built up its balance sheet. It is buying back stock and paying dividends and returning capital to shareholders, but it generated so much more in cash flow than it returned that its balance sheet built up in cash. Also, it increased long-term investments, which similarly are not invested in the company's operations. That metric increased by 700 million up to 3 billion. Now, property, plant, and equipment is employed in the company's business, but this metric only increased by 400 million. So the vast majority of the company's increasing total assets came from non-employed capital, not employed in the business operations. Therefore, the earnings per share increasing by 12% was pretty solid considering they did not increase employed capital on the balance sheet. While cash flow from operations was solid at 2.4 billion in the latest quarter, it was down from 2.6 billion in the same quarter the prior year. The good news is that the majority of that change came from non-operating assets, or net change in operating assets and liabilities. These are changes in inventory levels, accounts receivable, accounts payable that fluctuate frequently, and over time they balance out. However, the company's net income was higher, which drove the vast majority of the increase in cash flow from operations. Similar story in the 9 months ended July 28th, where cash flow from operations decreased to 6.1 billion, down from 7.1 billion in the 9-month period last year. And again, the reason for the decrease is the change in working capital assets, changes in inventory, and changes in accounts payable and accounts receivable, which fluctuate frequently and don't distinguish and are not indicative of the company's cash flow generating prospects going forward. Applied Materials stock is now trading at a forward price to earnings of 20.58, and the analysts that are following the stock on Wall Street expect it will increase its earnings per share by roughly 16% each year over the next 5 years, driven by an increase in demand for its products and services, by an increase in effectiveness of artificial intelligence. So to update my recommendation of Applied Materials stock, which I had rated as a buy, I'm reiterating this stock, ranking it a buy again, and I'm doing that today, August 22nd. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.